You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Thank you so much for listening in. Recently, I'd had a few clients ask me about this topic, direct recognition versus non-direct recognition. And some of these people that I've spoken to are trying to actually use this as a deciding factor on what company they should work with, who they should work with, what's going to be best for them. I always recommend that you should work with somebody who you like, who you trust, who you feel is looking out for you, who has a good understanding of this, who is a good advisor, will be a good coach, just someone you trust and like, really, that you think will do a good job for you and knows what they're doing. I definitely think they should probably be an IBC practitioner or working with an IBC practitioner if they're have a mentor or something like that, because then you will know that they're in good hands and will be doing a good job, doing their best. Or at least working with someone who knows what they're doing. So some people are trying to do a deep dive to understand direct versus non-direct recognition and then making it a condition of who they should work with. Therefore, I thought I would do a podcast on this topic. There are other podcasts out there on this topic. I know that it's kind of getting more out there. People want to understand this. So I thought I would do one as well. So some companies are considered direct recognition. What does that mean? What does direct recognition mean? So these companies, these insurance companies are directly recognizing that you are the one borrowing against your life insurance policy. So because of this, since they're recognizing that you are the one borrowing, this causes a slight haircut on your dividend. Although I'm actually not aware of any company that directly states exactly how the dividend is affected, exactly how much it's lowered, and nobody's really out there spelling it out, explaining exactly what that looks like. Then there are other companies that are called non-direct recognition companies, and they are not directly recognizing that you are the one who borrowed against your policy. I've heard it said before that kind of means instead of giving you the cost or having it affect you directly as the one borrowing, they kind of spread that cost around. So it kind of just affects everybody because they're not directly recognizing anyone specifically or recognizing those borrowers who are borrowing against their policies. So since they are not directly recognizing you as the borrower, your dividends remain the same. They remain untouched. It just doesn't affect the dividend at all. With this direct and non-direct recognition, that actually is a difference in loan rates. So the loan rates on these two types of companies are different, or these two types of policies. So the direct recognition always comes with a fixed loan rate. You're only going to get a fixed loan rate from a company that is direct recognition. On the other side of that coin are the non-direct recognition companies, and they come with variable loan rates. And some variable loan rates have a high maximum. They might not be super high right now, but they have a maximum that they can go to that could be a lot higher. So if you're working with a company that has non-direct recognition or has variable rate loans, you might want to look into what that maximum loan rate is. I don't know if it'll affect your decision necessarily, but just might be some information you'd like to know. One company that somebody wanted me to look into or that they were comparing with recently had a current variable loan rate of 8.5%. That's pretty high right now. I don't know of a lot of companies charging at 8.5%. So just something to look into and be aware of. Now, that in comparison to fixed rate loans, my primary company right now has a guaranteed loan rate of 4%. Now, that loan rate is guaranteed at 4% for the rest of your life, for your whole lifetime. And I think that's a pretty nice option to have. The option to borrow at 4%, pretty terrific. One of the things that I love about the primary company that I work with for the infinite banking concept is that they offer both. And that's not common in the industry. So they offer both a direct recognition and a non-direct recognition option, and they allow you to choose what you would like to do. So you can choose what type of loan you want, and then in the future, you're able to change that if you want to. So I've heard before people online or other podcasts saying, well, you have to pay off that loan before you can change from direct to non-direct recognition with this company. But that's not the case. Actually, you just have to wait 1 year. So it just has to be 1 year before you're able to switch from direct to non-direct at any time. Even if you have a loan outstanding still and you're increasing that, you're borrowing more funds, as long as it's been 1 year since you last took a loan, you can take the opposite option if you want to. You can switch back and forth. Pretty awesome if you ask me. Now, that hasn't always been the case. They haven't always had these two options, something that's kind of newer. So people who have older contracts from this company, it may not apply to your contract. I know I've mentioned before that this particular company reached out to top IBC or infinite banking practitioners or agents and advisors and asked what they could do to make a better product for this purpose that we're using it for the IBC strategy. And they built something really great. They did a great job building a product that has a lot of the features that people are focused on or concerned about. And so I think being able to switch back and forth between non-direct and direct, or fixed rate loan versus variable rate loan, is pretty valuable. Now, when I first got into teaching people this strategy, nobody had really ever heard of that. They don't really know what that is. They have no clue whatsoever. It wasn't really a question that people had. But as more and more people started learning of the infinite banking concept and wanting to look into it and getting more focused and looking into the depth of all that they could look into regarding whole life in general, they started asking me, is this company direct recognition? Is the company non-direct recognition? And so it used to be something that I had to have a lot of conversation around or explain why you would want one or the other. So it's nice to not have to really go into either one. If they are focused or they really are determined to have a contract that has one type or the other, well, cool. You can switch back and forth. Very awesome. So now this isn't something you have to get hung up on or think, oh man, I made the wrong choice if you go a certain direction. You can have both options on the same contract. Super awesome. And if you do have this type of contract and you can switch back and forth, one idea might be to take a direct recognition loan, the fixed rate option, during the early years in the policy when the dividends tend to be lower. They're pretty small still in the beginning. Then later, you could switch to a non-direct variable rate loan if that's something that you think would be best for you, so that now there's no effect on your dividend, especially if you have a larger loan outstanding. But of course, remember that you are likely to be paying a higher interest rate on your borrowed funds when you switch to non-direct recognition or the variable rate option. So you just want to take a look at what that loan rate is, and then it's really up to you and what makes sense at that time for you and what you have going on. So with the company that I'm working with that has both options, for those contracts that have both options, the fixed rate option is at 4% and their variable rate option has been at 5.55. And now that can change all the time. It can change annually. It can be different. So you just want to be paying attention to it if that's something that you are concerned with. One thing to consider as well is that if you do have a lower loan rate from the company, that allows you to charge yourself a higher loan rate if we are following Nelson Nash's guidance on becoming your own banker and how to be an honest, good, solid banker and treat yourself like you would any other bank. You're going to want to charge yourself a higher interest rate, more like the going interest rate of whatever's out there, so that you can end up with the excess interest. So if the fixed rate option is at 4%, that gives you a lot of room to be able to charge yourself at a higher rate, say 8%, 10%, 12%, and make that excess on that loan that you're paying to yourself so that you can eventually cycle that around and turn that into more premium dollars in one form or another, maybe paid up additions, maybe you're starting a new contract, but so that you can grow your banking system. Makes it a little easier than if your variable rate is higher and then you have to charge yourself an even higher rate to cycle back that interest and receive it more for yourself. to flow more of your money back to yourself. If you have a lower loan rate from the company, you simply can choose to charge yourself at a higher rate easier. And that is if you are choosing to amortize each of your loans and keep track of the rates and payments for each one. So that is, I want to charge myself 8%. Yeah, the company's charging me 4%, but I'm going to charge myself 8%. And I want to pay this loan off over a 5-year time period or something like that. Then you have an amortization schedule to make sure you pay yourself back the full 8%. Or 10% or 12%, whatever you decide to put your loan rate at for your own banking system, which is the ultimate goal. If you are banking in the way that Nelson Nash instructed and taught, the goal is to send yourself more money to get used to making payments to yourself just like you would any credit card or any loan, and to then grow your banking system. One thing to note as well is that direct recognition can react to the market faster. So when interest rates go up, they can increase the dividend more quickly as opposed to non-direct recognition. I'll share a little of the wisdom I have from Nelson Nash. I had a client once who was asking this exact question when we first started working together, and I had the honor of being able to call Nelson Nash on the phone to ask him his thoughts directly. And he said, in the end, the result to the client is really about the same. He said, either way, it doesn't matter, that this difference is meaningless because it is all about your behavior. IBC is most definitely about your behavior. This is the most important factor when implementing this concept. It's all about treating yourself like an honest banker, keeping your money in motion like the banks do, and growing your banking system over time. People just want to look at comparing illustrations of different companies, but really it's all about your action and treating yourself like an honest banker and doing the right thing. And the way you're going to grow your system is through premium dollars. You're going to grow your system by increasing your premium, which you can almost never do within an existing policy. So paying yourself like an honest banker can help you achieve this goal because you will end up with more dollars by paying yourself a higher interest rate than the company can receive back. And you can put that money in as paid-up additions dollars or build it up and maybe start a second, third, fourth, fifth banking system, a second or third, fourth, fifth whole life policy for your banking system. Unless someone is trying to sell you an index universal life policy for the purpose of the infinite banking concept, which is a giant no-no in my book and that of the Nelson Nash Institute or any IBC practitioner, you generally cannot fund higher premiums in future years over and above what you started with, because when you start, that's basically your ceiling. And so even if the company allows it, like my primary company does allow it, they will allow you to put more paid-up additions into your contract than what you started with. It will almost certainly cause your policy to become a modified endowment contract. So now I hope that was helpful, useful information, and that you find it helpful in your understanding of this concept. If you decide you're ready and you want to move forward, you want to get a policy started or a banking system started, and you'd like to partner with me, feel free to reach out. You can reach me at Valerie@alphaomegawealth.com. And I hope you have a great week. Take care.
This is thepodcastfactory.com.